Hello again, this is Dr. Lindsay. And in this video, what I want to do is go over the yield curve, which is also known as the term structure of interest rates. Now, this may at first seem like one of the most boring graphs you've ever seen in your life or will ever see in your life. But as it turns out, it might be one of the most fascinating curves in all of macroeconomics. Very surprising here. So what the yield curve is, it shows the relationship between the yields that you make on government bonds and the term of government bonds. Right? What could be more boring than that? The yield on government bonds, how much interest you can make by buying government bonds, which is next to nothing. Who knew a graph of that could be so interesting? So on the vertical axis, we'll put the yield of the government bonds. This is an annual yield. So how much you would make in a year on interest if you held those bonds. And down on the bottom here is the term on the horizontal axis from very short-term bonds to long-term bonds. So down here might be the 1-month bond, the 3-month bond. And out here might be the 30-year bond. So we'll say here is the 10-year, and here is the 5-year, here's the 1-year. Because we could put the 20-year out here too. The US government doesn't make a 20-year bond, but I've heard some noises that they like to do that. Now, if we plotted the interest rates on here, as low as they are, generally what we see is something kind of like this, where the longer term bonds have a higher yield than the short-term bonds. So this 30-year bond is going to pay a little higher interest rate on your money than you could get on the 5-year bond is the normal shape. And the finance people are always trying to figure out just why that is. Why do the long-term bonds pay more than the short-term bonds? But they just do. And it's really depends on supply and demand. So there's a supply and demand for the 30-year bonds. Here's a supply, here's a demand. There's a supply and demand here for the 10-year bonds, and a supply and demand for the 5-year bonds. You have to remember they're all substitutes for each other. To some degree, the 30-year is a substitute for the 5-year bond, and the 1 year is a substitute for the 5-year bond. And they follow the same as other substitutes do. So the price in one affects the price in the other. Just like red pins and green pins that are substitutes for each other, bonds are substitutes for each other too. Now, this is the usual shape of this yield curve, but sometimes the steepness will change. The bond prices are always changing every day, and sometimes it'll flatten out. So this is normal shape. And occasionally, this curve will flatten out and essentially become kind of flat. So this is a flat yield curve. And it means that the long-term bonds interest rate, the yield on them is the same as the short-term ones. And once in a while, we'll actually see the short-term bonds have a higher interest rate or higher yield than the long-term bonds. So look like something like this. This is known as an inverted yield curve. And what's been noticed about this is that when this happens, it usually forebodes bad things on the horizon. The recession coming. It's a very good leading indicator. An inverted yield curve frequently means that a recession is on the horizon, maybe in the next 12 months. So we can use this as a signal, as a leading indicator signal of a downturn in the economy. And it's probably the best one really that's available. So we use this information by calculating what the yield curve spread is. It's a measure of the steepness of the yield curve. And the yield curve spread is the difference between the long-term bond yield and the short-term bond yield. So the difference between the long-term bond yield, usually the 10-year, the 10-year, and the short-term bond yield, and for the short-term bond yield, in the original research was the 3-month T-bill. So this will be the 3-month Treasury bill. So we're just looking at here, the 10-year yield minus the 3-year yield. So if that's positive, then it means it's a normal shaped yield curve. If it's inverted, then that number will be negative. So the signal is, what is the yield curve spread? And if it's negative, then that would be a signal that's highly correlated with a recession occurring in the next year, or maybe 2. I'll show you a graph. Okay, here's a graph of the yield curve spread going back to 1960. And in this case, this data comes from Fed, the Federal Reserve, and it is the 10-year rate minus the federal funds rate. And the federal funds rate is also a very, very short-term rate. It's actually like a 1-day rate, so very short-term. And once again, here the shaded areas are recessions. And what you'll be able to see here, the black line there is 0. So anything below that black line means the yield curve spread is negative. And if that happens, then there's a good chance of recession. So take a look at this recession started in 2008. The yield curve spread went negative about, looks like, almost 2 years before the recession started. It went negative. We go back to the previous recession. Oops. In 2001. And I'll try to look at that with a little close up. And you can see it went negative, at least a good year before the recession. And then it went positive as soon as the recession starts. That's not unusual. As soon as the recession starts, it gets back at becoming positive again. But you can see in 1998, it was negative for a while. So it was a false positive. There was no recession then. A few times it dipped down a little bit below it. The real signal here, according to the person that created this, is to use GDP data, which comes out every 3 months. So we're not looking at this from month to month or day to day. We're just looking at every 3 months to see what happens. And we'll keep going back here. Here's 1990, predicted that one. Good year in advance, a few false positives. Predicted things in the 80s. It was a double dip recession. Predicted this one in 74. Predicted this one in 1970. predicted one that didn't happen. Well, that looks like 1966. I encourage you to click on that link that I provided for you and take a look at this yourself. And also go and see what the current yield curve spread. As I'm doing it right here, it's positive. So I'm not too concerned about a recession, impending recession right now. Interestingly enough, the recession in 2020 was preceded by a negative yield curve spread. So it actually predicted that recession a year or so in advance. And some people noted that and were concerned about it, a recession coming. But I think that was entirely coincidental because that recession was caused by a pandemic that I don't think the yield curve could have predicted that whatsoever. Have there been any recessions where the yield curve didn't predict it? Kind of hard to find. It's probably the best indicator of all the leading indicators that there are. However, it is becoming more widely known. And when something becomes widely known, sometimes its ability to predict things go away. So we'll see what happens in the future to this yield curve, how well it predicts. Unfortunately, we don't have a lot of data points to look at. How many recessions are there we really have to look at over the last 70 years? Not all that many, so not all that many data points. But from what the data points we have, it does seem to predict pretty well. And it's certainly something to keep in mind and to watch.